Sometimes self-employed homebuyers are turned down when they should not be. In this episode of Talk Mortgage to Me, I'm going to be interviewing D.O., who is going to walk us through a real-life scenario about how he helped a restaurant owner who was recently denied a mortgage to purchase the home of his dreams. What's up, everyone? I'm Karina Mojica, and today I'll be asking the questions. And we put D.O. back in the hot seat to share another real-life example of how he made home ownership a reality after another lender said no. So what's up, D.O.?
What's going on, Karina? And hello, everyone in the TLOP world. Thank you so much for coming back to hang out with us for another edition of Talk Mortgage to Me. So a lot of people forget that I actually started in the mortgage industry as a loan originator. Throughout my career, I've personally funded well over 1,000 transactions. That means I've helped over 1,000 families achieve the dream of home ownership, or I've helped 1,000 families rewrite their mortgage in a manner that it's going to better suit their financial needs, wants, and goals. And this is a story that probably goes back a decade, but it happens every single day in this industry that I serve and that I've called my career for the past 20 plus years. And it's banks and lenders' inability to properly calculate self-employed income as is allowed by Fannie Mae, Freddie Mac, HUD, or even the Department of Veteran Affairs. And most times when we're looking at self-employed income and people being turned down, it's because the originator who is attempting to do the loan does not understand that you can add back in depreciation into someone's income calculation. So if you're self-employed, you know very well what depreciation is. For everyone else, depreciation is a write-off. If I'm using vehicles in my business, I can write off miles or I can write off depreciation. If I'm buying equipment, let's say in this case, restaurant equipment, and that restaurant equipment costs money, I can write off the cost of that equipment on my tax returns, which lowers my taxable liability, which means I pay less money in taxes. So as a business owner, you want to take advantage of all of these write-off opportunities. And some write-off opportunities, they hurt you when you're trying to obtain a home loan. But there's certain that they don't hurt you. However, if the lender you're working with or the bank that's trying to do your loan doesn't fully understand, recognize, or follow the standard underwriting guidelines set forth by Fannie Mae, Freddie Mac, HUD, or even the Department of Veteran Affairs, then you will find home buyers that are negatively impacted. So here's the real life scenario. I get a phone call one day. The phone call is from the listing agent. So the listing agent is the person who's actually representing the seller. And she is absolutely frustrated, almost in tears. Now, I personally know the listing agent. I've worked with her for the past 5 or 7 years. She's referred to me a dozen of her home buyers, all of which I have done the financing for their home purchases, and the transactions went smoothly. Now, this time she doesn't have the buyer, right? She has the seller. But the home's supposed to close in 2 weeks, and they just found out the buyer's financing is going to be denied. So before she cancels the contract, puts the home back on the market, and has to go tell the seller, hey, I'm sorry. I know you thought you're going to sell this home in 2 weeks. Now we have to put it back on the market. She checks with me. And like any good lender out there, I say, look, it depends. My 2 favorite words in the mortgage industry are it depends. That means I don't know, but let me take a look at it. That's because every scenario is different, and it truly does depend based on hundreds, if not thousands of factors. Well, she gets me in contact with the buyer, which really meant I had to talk to the buyer's agent. Then I got to talk to the buyer. They explained to me the situation. And I realized this buyer owns 2 restaurants. In fact, these are pizzerias. And for anyone who remembers back in the day, the all-you-can-eat pizza franchise, CC's Pizza, he owned 2 CC's Pizza franchises. And he had owned them for well over a decade. Now, when you looked at his tax return, it showed him making about $36,000 a year. $36,000 a year is not enough to buy the $500,000 home that he was looking to buy. But as I dug deeper into them and as I properly interviewed this home buyer, here's what I realized. He recently upgraded both of his restaurants, and part of that upgrade was brand new restaurant equipment. Well, you may or may not run a restaurant, and I've never run a restaurant, but here's what I can tell you about restaurant equipment. It's really effing expensive. So this guy goes out and buys new ovens for not just 1, but 2 restaurants. Well, that was an expense, and the IRS allows him to deduct that expense over the next, depending on the tax year and what type of expense it was, sometimes 3 years, sometimes 10 years. In his case, if memory serves me correctly, it was 3 years. So what's happening is this guy is actually deducting $100,000 from one restaurant, $100,000 from the other restaurant. It's lowering his taxable liability, but this other lender is taking it away from his qualifying income. Well, because you don't have to buy new ovens for a pizzeria every year, then he should not have been hit or negatively impacted by this deduction, meaning this is a depreciation deduction, and depreciation deductions can be added back in. So what does this really mean? The guy's not making $36,000 a year. He's making $236,000 a year, almost $20,000 a month. Well, let me tell you this. $20,000 a month is more than enough money to qualify for a $500,000 property. In fact, he probably could have qualified for a $1 million property. However, he's a pretty budget conscious guy, and he decided, you know what? I like living below my means. $500,000 home is more than I need. It's more than I ever imagined myself living in, and that would be enough. Well, for me, I won a loan. As a loan originator, I won a $4,000 commission. But more importantly, I saved the seller the headache of having to put the home back on the market. I saved two realtors the headache of possibly never getting paid for all the work that they did by holding a transaction together. But I found a way to yes for this small business owner, this guy who is making really good money, but unfortunately, he was taking advantage of certain tax breaks, and another lender was trying to tell him that no, he didn't qualify, where if that lender fully understood how to underwrite self-employed income, they would have seen that not only does he qualify, but he qualifies for way more home than he was looking to actually purchase. More of the stories, we closed 2 weeks. The guy became a homeowner yet again. That home today is probably worth well over $1 million. And I won over a new agent. And I know that doesn't help you, the homeowners looking to follow in this guy's shoes. But as a business operator, it was my time to shine. I now have another realtor in my marketplace who is absolutely trusting me with any home buyer that they have. I share this story because this happens day in, day out, week in, week out, month in, month out, throughout the country, from Spokane to Key West and everywhere in between. And if this sounds like your scenario, or this sounds like the scenario of one of your customers or your clients, or maybe even someone you know, before you let someone turn you down because you're not showing enough income on your tax returns, make sure you get a second opinion from another lender.
Hey, Dio, is it really that common?
Karina, believe it or not, it is. I mean, this isn't anything new. I entered this industry back in 2004, so I'm 20 plus years into my career, and there's not a month that doesn't go by where we don't come across a loan file that someone else said no to. But if they knew the guidelines better, if they knew how to properly calculate income better, they could have actually turned that no into a yes.
But aren't there self-employed people who do have issues?
Oh, yeah. There's 100% people who, look, their issue isn't depreciation. This guy, it was super easy. His write-offs were mainly depreciation. And because of that, I'm allowed to add depreciation back into his qualifying income. Now, when people are writing off supplies, meals and entertainment, travel, no, we're not adding those things back in. And I see my fair share of self-employed home buyers or mortgage applicants who aren't going to qualify because they either took too many liberties with all of the tax write-off opportunities, or they neglected to properly, and I'm going to use air quotes here, properly account for all of the income that their company had received or all of the revenue your company had generated.
But aren't there loan programs for those people too?
Look, there are. In the day and the age that we live in, there's what are called non-QM loans. Non-QM truly stands for you're not qualified, right? But it doesn't mean you can't qualify. It just means that you're not going to qualify for the traditional financing, which is conventional financing. Think Fannie Mae, Freddie Mac. FHA or VA financing are probably the most popular types of financing that we're doing these days. But these non-QM loans have what are called bank statement loans. And a bank statement loan is a great loan product for people that they don't show enough income on their tax returns. They don't have a depreciation they can add back in. What a lender can do is look at their past 12 months of business bank statements, and they can see how much money is being deposited into those bank accounts. And from there, they will be able to formulate a income that they feel comfortable using as qualifying income.
Okay, so where do we go from here?
Look, I think we gave the people enough in this segment to get their wheels turning and get them to understand that no doesn't always mean no. No sometimes means not now. No sometimes means not that product. No sometimes means go find a new lender. If you're looking for a new lender, or heck, you're just starting in the process, whether you want to get connected to a real estate agent or to a mortgage loan originator, please know that we are one of the most connected organizations in the entire real estate and mortgage industry. All you have to do is click the link below, fill out a quick form, and we will connect you to one of our TLOP approved professionals so that you can get a one-on-one consultation. These consultations are free, and it's typically the first step in either the home buying process or it's the next step in determining whether or not the information you're getting from another professional is truly accurate or if you're due a second opinion.
Isn't there more?
Well, there is more. Look, if you like this type of content, do us a favor. Click the subscribe button. Give this episode a like. Comment, especially if you have questions. And more importantly, remember, sharing is caring. We love it when you share our channel with others that you know will just benefit from the type of content we produce.